So this is chapter 16, the lecture on job costing. And let's just step back a moment. Chapter 15 was the introductory chapter on cost accounting. And the chapter basically illustrated how we would basically move costs through the inventory accounts into cost of goods sold, and then reflect those costs on the income statement. So it was the beginning chapter in terms of being able to cost out products in an aggregate sense. So in terms of all the products that are sold, what were the cost of those that are reflected on the income statement? In the next two chapters, we're going to talk about how we're going to specifically cost out individual products or specific product quantities or product processes. So the next two chapters are helpful in determining how that actually gets done in real life. And it's done in real life using two different cost accounting systems. The first accounting system would be job costing. So that's this chapter, chapter 16. And here what we're doing is this is when we're looking at a company that is making batches of products. So let's say, for instance, the guitars is a good example. We're making 100 acoustic guitars. So that batch of 100, how are we going to assign costs to those 100 guitars? And then, of course, we could divide the total cost by 100, and we would know the cost of each specific guitar. So what we're doing is we're really costing out a quantity of products. So what's the cost of those 100 guitars that we just finished? And so that's what we're going to do in this chapter. We're going to work through the process that's involved in assigning costs to specific jobs. So the job is the batch. So in that case, those 100 guitars would be one particular job. And we'd allocate cost to that job, and then we would know how much the cost of that quantity of products was. In the next chapter, chapter 17, we're going to be talking about process costing. And there what we're doing is we're using a different technique where we're costing out the process or the cost of a department. So what's the cost of, let's say, the welding operation or the mixing operation or the welding department or the assembly department. So and then all that becomes part of the cost of ultimately the products that are produced. So in this case, we're really looking at products that are produced on a more continuous basis. So this would be, much more common in, let's say, a chemical factory or a oil refinery where the product is flowing through a pipeline, let's say, and various processes are occurring all along the way until we have a finished product. What are the costs of all those processes? And then those get assigned to the products. So those are the two different types of systems that are in place, and we're going to be talking about job costing in this particular chapter. Job costing is going to be the easiest. It's going to be the most similar to what we just did, and with one variation, and that's really with the factory overhead account. We'll get to that in a second. Okay, so job costing in general, what we're going to be doing is we're going to be, first of all, establishing a separate work in process account for each job. So we're going to have, for instance, job 1. We'd have a separate work in process account. Job 2. And however many jobs we're going to have throughout the period or throughout the year, we're each going to have a little work in process subsidiary account that all combines in total to equal what's in the general ledger work in process inventory account. So it would be just like all the customer accounts totaling up to what's in the accounts receivable general ledger account. These would be the individual jobs in total, giving us what's in the total work in process inventory account. So here, each one of these would have, direct materials, direct labor, and factory overhead. Each one of these accounts would be assigned direct materials, direct labor, and factory overhead costs into them. And then when they're completed, then of course that's transferred out, and that completed cost tells us the total cost of that job. So we're going to assign direct materials and direct labor directly to the jobs because we're going to know that. By definition, we know direct materials and direct labor can be traced directly to individual products. Factory overhead, though, is assigned to jobs using what's called a predetermined rate. So what we're going to do is we're not going to take individual factory overhead costs and somehow allocate them all throughout the year to different jobs that are occurring at different times throughout the year. That would be impossible because jobs are occurring at different times, different than when we would receive, let's say, the insurance bill. We might receive an insurance bill in January, and we might not even start a job until December. Well, somehow that December job still needs to get the some portion of the cost of the insurance on the factory, but it would never do that if we just allocated the bill to the jobs that are going on at the time we receive the bill. So what we want to do is we want to get all of the factory overhead, a bit of all of the factory overhead into each job based upon how much activity there's going to be throughout the year. So what we're going to do is at the beginning of the year, we're going to calculate a predetermined factory overhead rate. So we're going to take the annual factory overhead. So this would be for the whole year, what we think the total factory overhead is going to be for the whole year. So we're going to have to make an estimate. And we're going to divide that by whatever we think the relevant activity base might be. So this maybe is direct labor hours, again, for the whole year. So maybe, for instance, maybe we think that factory overhead is going to be $100,000 for the year. Maybe we think we're going to incur a total of 50,000 direct labor hours throughout the year. That means that every time we have a direct labor hour on any job, it gets $2 of factory overhead. And that's how we're going to do it. So the way we're going to do it is we're going to set up a factory overhead account. We're going to establish a new general ledger account called factory overhead. And what we're going to do is we're going to put the actual factory overhead costs in as debits. So the actual costs come in here, and then those costs are applied out to the jobs at our predetermined rate. So in effect what happens is if we were to estimate exactly and factory overhead came in at exactly $100,000 and we incurred exactly 50,000 direct labor hours for all of our jobs, then our actual costs throughout the whole year would have been 100,000, and we would have applied out exactly 100,000 to all of our jobs throughout the year. And we would have had a zero balance in our factory overhead account. All of our actual costs would have been allocated out in a smooth, pro rata way to all of our jobs throughout the year. And all of our jobs would have gotten a portion of all of those actual costs. So that's why it's done that way. Now, in reality, is actual factory overhead going to be exactly 100,000? Probably not. Are there going to be exactly 50,000 hours? Probably not. But if it's close, then hopefully we're just going to have a small balance, either debit or credit in the factory overhead account at the end of the year. And then that we would just close out to cost of goods sold. This factory overhead account is a temporary account, and it would be closed each year. It would be closed out each year, and typically it's just done by moving that balance into cost of goods sold, unless it's a very, very large balance. in which case then you'd have to go back and figure out why these estimates up above for factory overhead or for hours or whatever that activity base was, why those were wrong, and maybe reallocate that to all the back through to those jobs and correct that. We're not going to do that. We're going to assume that our estimates were fairly accurate. Okay, so this is the first part. We're going to come back and do an example. I'm going to set up an example, and we're going to work through a couple different examples of how we're going to cost out some products. Okay, so let's say we have the following example. We have 3 jobs. We have job 1, we have job 2, and we have job 3. During the period, job 2 and job 3 are complete. So this is done, and this is done. Job 1 is not completed. If you look up above to the right, we determined our predetermined rate. We had factory overhead dollars. We expect our full year dollars to be $75,000. We are using direct labor dollars as an activity base, and we've estimated that to be $100,000. So we're going to apply factory overhead at a rate of 75%. So here, in terms of applying, it's going to be 75% of direct labor dollars. So that's how we're going to apply factory overhead. And you see the rest of our accounts. We've got our materials account, got our work in process account, our finished goods account, and then, of course, our new factory overhead account. Those 4 accounts are general ledger accounts. Our job 1, 2, and 3 accounts are subsidiary work in process accounts. The total of those accounts will add up to be the work in process general ledger account. Okay, so as we go through this, I'm going to go ahead and make journal entries so we can see how those accounts would be, how these transactions would be recorded. So I'm going to go ahead and just scroll up a little bit here. So the first step is we're going to assume that we already have made a purchase of $25,000 of materials, and the entry there I think would be pretty simple. It would be a debit to materials inventory, a credit to accounts payable. So I'm not going to go ahead and do anything more with that. So now what we're going to do is we're going to requisition materials into each job, into the factory, and then assign those to each job. So basically, what we're going to do is job 1, the direct materials, amounts to $4,500. We're going to assume we have 0 beginning balance. We're going to assume this is the first month of operations just to keep it simple, but we could certainly start off with a beginning balance. For job 2, we're going to assume that $6,000 of direct materials were requisitioned in, and for job 3, $9,000. The total of those 3 would be the sum which would go into our general ledger account, and that would be $19,500. We're also going to assume that, of course, that would come out of our materials, so those direct materials of $19,500 would come out. We're also going to assume that we have indirect materials, so I'm going to use IM, like cleaning supplies of $2,500. What's going to happen is that's going to go into the actual side of our factory overhead.